So first of all, knowledge checks. The income tax knowledge check is now open for you to retake. I'll leave it open so that you don't have to crank through it right now. But most of this, if you've taken a tax course, should feel sort of reviewish. But I just wanted to emphasize, especially when it comes to retirement planning, you take taxes into account to a significant degree. For example, this first one, 3 years ago, you purchased a share of Computex stock for $32. And we care about how many years ago it was, because if you own it for more than a year, you get long-term capital gains tax treatment, which is so much better than if you own it for less than a year. Then you're taxed on that gain like regular ordinary income, which is much worse tax rates usually. So we care about how long you owned it, and we care about whether or not there was a gain or a loss. And that's what generates the potential tax consequence, the time you held it and whether or not you made money or lost money. So when we're trying to figure out capital gains and the impact of gains and losses, that factors in when we're looking at a normal taxable brokerage account. Because if you would have purchased a share of Computex inside of an IRA, and then while it's still inside the IRA, you would have sold it and then purchased something else inside that IRA, that's not a taxable event because it all happened behind the tax wall of the IRA. We only really care about gains and losses when it happens inside a taxable brokerage account. Hopefully that makes sense to you. All right, so if you're self-employed, you have to pay both the employer and the employee portions of Social Security and Medicare. This is also a review. We talked about the Social Security and Medicare tax back in the social insurance chapter. On a combined basis, they're 15.3%. When you are self-employed, you pay for all of it, right? When you are employed by someone else, you only pay half. So 1.45 is the amount for your Medicare tax if you're employed by someone else. 6.2 is the amount of your Social Security tax when you're employed by someone else. And when you're employed by yourself, you multiply those times 2 and add them together and get 15.3% that you owe for self-employment tax, which is just both sides of Medicare and Social Security. That can be confusing. Clearly, it tripped up a few students. And then Elizabeth has taxable income of $45,000 in 2020. If she contributes $2,400 pre-tax to her 401k plan at work, how much will this lower her taxable income? This may have seemed like a trick question, but it was not. It was just intending to help you understand what is the deal with reducing your taxable income. When you make a pre-tax contribution, you reduce your taxable income dollar for dollar. So let's just maybe focus for a moment on the word taxable income or the phrase taxable income. Elizabeth might have made more than $45,000 that year. And if she's single and enjoyed the standard deduction, I always have to cheat and look at my cheat sheet. The standard deduction for an individual person is, hold on, let me find it. Looking. I know it's around 12,000, but let's get to the exact number. Standard deduction, individual, $12,550. So your gross income minus your standard deduction generally gets you to your taxable income. So once you arrive at that taxable income number, you know how much we're going to munch into the marginal tax brackets. So a taxable income of $45,000 per year, that would put Elizabeth solidly in the 22% bracket, which is what a bunch of people were already thinking about. 17 people were like, oh my God, I got to figure out what this saves her in tax. That's not what this question asked. The question asked, how much is her taxable income going to go down by if she makes a $2,400 pre-tax contribution to her 401k plan? It reduces her taxable income dollar for dollar, so the answer is $2,400. Does that make sense? feel free to, there's only a few of us. If it's easier to just take off your mic to talk, you are welcome to. Let's go through this next one. Let's see. So, what other ones do we want to talk about? I'll only focus on the ones where a bunch of people got wrong. 100% on that one, 100% on that one. Ooh. This one clearly tripped people up. The amount of income taxes that you actually pay is based on your taxable income. Taxable income. Everybody got that right. Here's another one. Assume that you gross $80,000 this year and have a marginal tax rate of 28%, a state income tax rate of 4%, a city income tax rate. We don't have a city income tax rate here in Madison, but places like New York City, for those of you who are going to go to the big city when you graduate, they have big city taxes that apply to your earnings. And we all have to pay Social Security and Medicare tax. Of course, Social Security has an earnings limit to which it applies, but in this case, for somebody grossing $80,000, it still applies to them. So assume that you gross $80,000 this year and have a marginal tax rate of 28%. The state income tax rate, blah, blah, blah. So what is your effective marginal tax rate on your last dollar of earnings? We don't really care about the 80,000 because we've already been given every other piece of information that we need. We've got the 28% tax bracket for the federal tax, the state income tax rate of 4%, city income tax rate of 1%, plus Social Security and Medicare. We're just adding them all up. That's all we're doing. All right. Most people got that one right. Contributing $2,000 to a tax-deferred retirement plan when you are sitting in a 28% tax bracket will save how much in federal income tax? Well, if you wouldn't have contributed that $2,000, you would have been taxed on it at a rate of 28%. I should look at what the other 5 people put in. Maybe they just messed up the punctuation and they really got to the right answer. But now when you resubmit it, you can have it at the right number. So 2,000 times 0.28 is $560. So thankfully I did the math right too in that question. Any questions on those so far? Looks like everybody got those right. Sources of tax-free income. It should say sources of federal tax-free income because interest on municipal bonds is free of federal income tax. If you live in Wisconsin and you own a Wisconsin municipal bond, then you get 0% tax on both from both a federal level and a state level. People who are in high tax brackets love municipal bonds. And a municipal bond is just issued by a municipality. And the pork chop they tie around their neck to get you to buy their bond is no federal income tax. So you see lots and lots of options for for municipal bond funds, especially for bonds issued by big states like California, Arizona, New York, et cetera, or where there's a lot of old rich people. That's where you'll find a lot of municipal bond funds based out of. But we can all buy into those bond funds and enjoy federal tax breaks on the interest. We don't have to pay federal income tax. However, the interest rate is usually lower than what you would get on a normal bond because they know, they're like, haha, we know you're enjoying a big tax break, so we're not going to pay as much in interest on this bond. Another tax-free source of income is inheritances. And so most inheritances that you'll receive, you don't get taxed upon receipt of it. Now, if you inherit a traditional IRA, you're going to be forced to take distributions and you'll owe income tax on the distribution. I'm sorry to say. But passive income, there is no income tax. There is absolutely income tax on passive income. This is like if you own a rental property. Although if you own it and you manage it, it's not very passive. But if you own it and you pay somebody else to manage it and you keep the profits, that's considered passive. Gambling winnings are absolutely taxable, just like a lottery winning is. And then it's a. All right, so what would be the equivalent taxable yield on a 9% municipal bond if you're in the 28% tax bracket? This is a very useful little piece of math for us to do, so let's do it together. So what is this asking? What would be the equivalent taxable yield on a 9% municipal bond if you're in the 28% tax bracket? So it's saying, you rich person, you love muni bonds. Muni bonds. You could also think of this as any analysis involving a tax-free interest payment that you might be receiving or saving. And I'll give you another example in a moment. Don't let me forget. So a muni bond, a municipal bond, again, is free of federal income tax. And for this reason, they're really only popular to own inside of a taxable brokerage account. You don't need this freebie inside of an IRA because you get tax deferred growth inside of an IRA. And owning a municipal bond inside of an IRA is sort of dumb because a municipal bond, we know, pays less than a regular bond. I digress. So when we talk about muni bonds, we're only going to usually focus on owning those inside of a taxable brokerage. That's a brokerage that you're going to get a 1099 every year from the IRS saying, hey, pay taxes on this, except wait a minute, you had a muni bond, never mind. So with a muni bond, free of federal income tax, pays less typically than a normal bond. So let's say muni pays, what do we say, 9%, that'd be fantastic. You are in a 28% tax bracket. And you're being sold this muni bond. And you're like, it's that 9% muni bond, let's pretend it seems low. Seems low. What would I have to earn in a regular bond to equate to a net 9% growth rate? So we know if we buy a non-muni bond, what would we have to get? Let me get this out of there. Pays 9% net, which is the equivalent of earning what in a non-muni bond? Because of this, income tax applies here, but not here. No tax. We got to figure out what would we have to earn in this non-muni bond, which would be taxable, in order to equal 9%. Well, that math is pretty straightforward. It's the tax-free rate of 9% divided by 1 minus the tax rate. So equals 9% divided by, what is that, 72%? Divided by 0.72 should give you, in here once again, 9 divided by 0.72 should be 12.5%. Yes, I got it right. 12.5%. So that's now the benchmark. You're like, hey, if that muni bond is paying 9%, but I can get a 12.5% rate on a regular bond, they're about equal. But if I can get something other than, if I can get something higher than 12.5% in a non-muni bond, I'm going to go that direction. So a test question would typically be, Jacqueline is in the 28% tax bracket. she's being offered 2 bond funds. One is a muni bond that pays 9%. One is a corporate bond that pays 15%. Which has a better tax-adjusted return for Jacqueline? That's the kind of question you're going to see. Fair enough? Does that make sense? What was this one? Gabe is in the 37% tax bracket and has some extra cash on hand. He plans to either buy a bank CD to earn some extra interest, or he'll put it towards his mortgage that has a rate of 3.78%. I promised I would come back to this concept, and thankfully this quiz did it for me. All right, so we talked about the muni bond and how the muni bond is like, because it's federal income tax free, you oftentimes have to do the math and decide what's a better deal in my tax bracket to go muni or non-muni. This next scenario comes up all the time with my clients, especially those who love guaranteed rates of return. They're like, what should I do with this extra money I have? I don't want to just leave it laying around, and my mortgage is so low right now. What should I do with my money? I don't want to pay down my mortgage because I think I could do better in the market. And a lot of this is not black and white. This is a little bit of this is a mix of risk tolerance and preference. But when we talk about a mortgage that has a rate of 3.78%, if you have a mortgage on your house, that's a loan, and you're giving some institution 3.78% interest. They're enjoying 3.78% interest on your payments, right? Because you borrowed a bunch of money, and they're like, hey, you are making a bank some money, and technically they're making more money off of you than you're making off of them, because if you check what you're getting in your savings or a CD rate right now, it's horrible. So if you're able to pay off that mortgage, you're getting a guaranteed savings of 3.78%. So this same muni bond calculation applies to doing an evaluation, in my opinion, of paying down your mortgage. This gets a little complex because people are like, wait a minute, isn't mortgage interest deductible? It is if you're going to itemize your deductions, and right now nobody's itemizing because the standard deduction is so big. I shouldn't say nobody. Very few people are itemizing because your standard deduction is so big that your mortgage interest doesn't really factor in. So if we assume that we're using a standard deduction, and Gabe's in the 37% income tax bracket and has some extra cash on hand, and he's either going to buy a CD, which, oh, by the way, pays nothing, but we'll have to do the math right now on what he would need to earn, to compare to paying off his mortgage. When you pay off your mortgage, I know it's kind of a weird comparison. Students might suffer like confusion because if you don't have a mortgage, you're like, I don't get any of this. But when you have a mortgage, you have that big loan, that interest expense is sort of like paying it off is like the reverse. Well, it's a lot like making 3.78% because it was being flushed and now it's being kept if you just pay it off. So 3.78% on your mortgage pay off or pay down of 3.78% versus a CD. So what would you have to get for a CD rate in order to equal the value that you would enjoy in your pocket after tax of paying off the mortgage? We're back to that same calculation of 3, because CD interest is taxable, and it's taxable like regular income. So we're looking at 3.78% divided by 1 minus your marginal tax rate. Again, which rung of the ladder did you earn your way into with all of your other earnings? So if you're like, if you make a ton of money and you're like, oh, I'm going to make some money off a CD, you're like, that CD interest is going to be taxed at your highest marginal rate. So let's be thoughtful about what we're going to do with that money. So 1 minus your marginal tax, so 3.78% equals 0.63. So 3.78 divided by 0.63. 3.78 divided by 0.63 means we would have to get flipping percent on a CD to equal the same juicy benefit of paying off your mortgage. You're like, why are we comparing this to a CD instead of some other investment? Why are we comparing this to a CD instead of some other variable investment? What do you think? Any idea? Wild guess? Well, it's because of this. Because when you pay off your mortgage or even pay down your mortgage, you have to pay it off. Every extra dollar that you put towards that principal is guaranteed to save you whatever your interest rate is on the mortgage. Guaranteed. I'm going to say that word again. Guaranteed. It's guaranteed to save you 3.78%. There are very few investments on the planet right now that will pay you a guaranteed 3.78%. You might be like, that is so boring. I'm young. It's good. I could live forever. And I'm definitely going to beat 3.78% over the long haul. Well, that's great for you. But the guaranteed nature of that savings means if we're going to compare that to an investment, we have got to find something that comes with guarantees. And guess what comes with a guarantee? CDs. CDs are guaranteed to give you whatever mediocre rate they're paying right now. And there's no way, Jose, that you are finding a CD that will pay you 6% right now. I don't care what the term is. If you can find one, you must tell me. It's probably in another country. All right. I digress. Well, that's the last one. I'll be damned. At least I think it is. Yes. So that quiz is open for you to retake. The other quiz I also reopened for you to retake. I say, knock yourself out. You know that the book that that the other quiz came out of, the Engage e-text, is searchable, for crying out loud. Search the text for the question because it's easily findable. Anywho.